Hello and welcome to another accounting tutorial. Within this video, we'll be covering the topic of depreciation. Well, firstly, if you could hit the like button, subscribe to the channel and click the bell icon, it would be hugely appreciated. I'll be bringing regular content to the channel to try and help you further your accounting knowledge and hopefully help with your exam preparation. So the aim of this session is to introduce you to the world of depreciation. What is it? How does it work, and how do we record it in our accounts? Firstly, let's look at what depreciation is. I'll put the technical definition up on screen now, but the slightly easier explanation for depreciation is the amount of money we expect a non-current asset to lose over the time we own it. Typical examples of non-current assets would be vehicles, IT equipment, machinery, buildings. Basically, it's something that we own and expect to have a lifespan of 12 months or over in our accounts. It's shown / recorded in two places, both in the profit or loss as an expense and in the statement of financial position as a reduction to the original cost of the asset. Now, it's worth saying at this point that when I say reducing the cost of the asset, the cost is the cost. That doesn't reduce as such. However, what we're trying to say here is if we bought an asset, let's say a laptop for £5,000, we'd record it in our assets for £5,000, but in a year's time, it wouldn't be worth £5,000 anymore. So the value in our accounts would technically be incorrect. That's where your accumulated depreciation comes in, because it shows the depreciation over the time you've owned the asset and offsets against the original cost. For example, let's say that laptop for £5,000 lost £1,000 within the first year. By having the depreciation in our accounts, after year one, you'd have the original cost of £5,000 and depreciation of £1,000. Therefore, the value in our accounts would be showing as £4,000. Now that £4,000 does have a name, and we call that the net book value, which just means the cost less accumulated depreciation. It can also be referred to as the carrying amount of the asset. Next, so why do non-current assets depreciate? Well, we've got wear and tear, we've got passage of time, and we've got economic reasons, being the main three. Wear and tear, nice and straightforward. The asset gets used, it's worth less. You use a machine, and the more you use, the more worn it would get, and it would lose value. Passage of time, the asset naturally loses value just because it's getting older, such as a car. Now, wear and tear will obviously come into this, but equally, just over time, because the vehicle's getting older, it loses value until a certain point. And then eventually, it might go back if it becomes a classic. Moving on. Economic reasons, so new designs, not longer meeting requirements. This is a really common example here with technology. Because things move at quite a fast pace, the old tech becomes redundant due to newer models. And there is one exception to this, which is land, which wouldn't depreciate, specifically freehold land. But all other assets we would depreciate. Now there are two key methods for calculating depreciation: straight line method and the reducing balance method. So what are each of these? Well, straight line basically means that we depreciate the asset for a fixed amount each year of ownership, i.e. if we depreciate the asset for £1,000 in year one, it would also be £1,000 in 2, year 3, etc. for the useful life. Now the reducing balance, on the other hand, we depreciate based on a percentage of the net book value, which we spoke about earlier. Now let's make sure we're happy with the math behind each of these with an example. So to work out the straight line method, we use the formula on screen here. So cost of the asset less estimated residual value divided by the useful life of the asset. Now, just to quickly explain the estimated residual sales proceeds or value, this is how much we expect the asset to be worth at the end of its useful life. So it could be zero, but we also may think that it would be worth something by the time we finish with it. Now, the first thing I want to say about calculating using the reducing balance method is that we ignore any residual values. I'm getting that in early because it's a really common mistake that I see people make when answering depreciation questions. So to calculate depreciation using the reducing balance method, we will base it on a percentage that will then be multiplied against the net book value of the asset. Therefore, the depreciation amount actually gets lower each year. That might be hard to picture, but it will become abundantly clear when we go through the case study. Now let's have a look how this would look in practice. So the practice information we'll work with is as follows. We purchase a motor vehicle at a cost of £10,000. The useful life of the vehicle is 5 years and the residual value is £1,000. Let's see how we calculate the depreciation using each method. Firstly, straight line method. Let's remind ourselves of the formula again. Cost of the asset less the estimated residual value divided by the useful life. We will therefore do the cost of 10,000 less the residual value of 1,000 to give us 9. Divide this by 5 and that would give you a yearly depreciation amount of £1,800. Now on to reducing balance. So just to remind ourselves, we ignore the residual value for this method. In this example, the business depreciates using a reducing balance method at 25% per year. So for year 1, we would do 10,000 divided by 25% to give you £2,500. This leaves us with a carrying amount at the end of year 1 of £7,500. Then in year 2, we multiply this 7,500 by 25% to give you £1,875. So your depreciation for year 2 is 1,875. We then take that off and that leaves us with a carrying value at the end of year 2 of 5,625. We then rinse and repeat this for the remaining years of ownership. So we can see from this that the depreciation starts out higher and gets lower over time. And this would suit something like a vehicle really well, where the depreciation tends to be higher at the start of ownership and tapers off the longer we own it. So we've looked at how to calculate depreciation using the 2 different methods. What we need to look at now is how to actually record those depreciation amounts in our accounts. To record the depreciation, we need 2 accounts, the depreciation charge and secondly, the accumulated depreciation. Now, to record the depreciation, we would debit the depreciation charge account and credit the accumulated depreciation. With that in mind, let's have a look at a case study to see how this would work. Hawkins Limited purchased a new computer on the 1st of February 2020 for £3,600. The business policy for depreciation on IT equipment is straight line over 3 years with no residual value. A full year's depreciation is to be charged in the year of purchase and the financial year runs from the 1st of January through to the 31st of December. Record the depreciation in the accounts to the 31st of December 2021, show any transfers to the profit or loss or balance to be carried down on each account. So firstly, let's calculate our depreciation amount. The laptop was £3,600 and to be depreciated over 3 years with no residual value. Therefore, it would be 3,600 divided by 3 to give you a yearly depreciation amount of £1,200. So we start off in year 1 with our 2 accounts as shown on screen. We then debit the depreciation charge for £1,200 and credit the accumulated depreciation for £1,200. At the year end, the balance on the depreciation charge will be transferred to the P&L. To do this, we would credit the depreciation charge and debit the profit or loss. The accumulated depreciation balance would then be carried down into the following year. We will now continue to do the postings for our second year. So as we can see in our accounts, the depreciation charge starts with a nil balance as this was transferred to the P&L at the end of the previous year. On our accumulated depreciation account, we have the balance brought down from the prior year. We can now enter the depreciation amount in year 2. So again, we would debit the depreciation charge for £1,200 and credit the accumulated depreciation account. At the end of the year, we'd follow the same process as in year 1. Start off by transferring the balance on the depreciation charge to the P&L by crediting the expense and debiting the P&L. then the balance on the accumulated depreciation needs to be carried down to the following year. We would therefore calculate the new balance by adding the 1200 to the existing 1200 balance on the account to give us a new balance to be carried down of £2,400. Now, the next thing I think we should just mention is depreciation policies. So it's likely that most businesses will charge either a full year's worth of depreciation in the year of purchase or in the year of disposal. It's also possible they pro-rata the depreciation if they bought the asset partway through the year, in which case all you need to do is calculate the depreciation for the year, divide it by 12 to get the monthly amount, then multiply this by however many months you've owned the asset in the year. Within the depreciation policy, it will also sort of set out each class of assets and how to depreciate them. So it may be that IT equipment's done on straight line, and you may have, for instance, vehicles done on reducing balance. It's also worth noting that depreciation is a non-cash transaction. There is no physical money being paid out of the business. It is purely an accounting adjustment to show a more realistic valuation of assets in our accounts. The last thing I'd like to touch on is just the international accounting standard that covers the treatment of property, plant and equipment, which is IAS 16. This sets out regulations on how non-current assets should be dealt with within accounting. And the 2 points I'd like to draw your attention to are that it states that all non-current assets having a known useful life are to be depreciated, and that the depreciation should be reviewed on an annual basis to make sure that it's accurate. So that wraps up the video. I really hope you found the information useful. And again, if you could hit that like button and subscribe to the channel, I'd be eternally grateful. Thank you very much for watching. I'll see you in the next one.